is going to cover the Fibonacci retracement, dealing with the standard Fibonacci sequence, the numbers that are used by traders. The first thing I want to say is that you don't need to think too much about why these numbers exist, right? If you want, you can research what the Fibonacci number is. I'll give a quick overview of it, the Fibonacci sequence. It's a sequence that occurs in math. It's just a general mathematical sequence, right? And it occurs all throughout nature, all throughout the world, all throughout the universe. You see these repeating patterns of numbers. And the numbers are, it starts with 0 and then 1. And each number thereafter is the sum of the previous two numbers. So you have 0, you have 1, you have 1, you have 2, 3, 5, 8, 13, 21, 34, and so on. Okay? Why does this matter? Well, particularly with one of the numbers, the golden number, they call it the golden ratio, is that if you get the ratio of any number to the number next to it, it's approximately 0.618, right? That is an approximation, and that number seems to appear everywhere. And for whatever reason, people call that a magic number, golden ratio, whatever. The ratio of any number to the number that is two places to the right is approximately 0.382, right? And so this is not a trading concept. This is a mathematical concept. Why does it matter in trading? Because traders over time, people in the markets, have assigned value to it. They have used the Fibonacci numbers, the Fibonacci sequence, and they've applied it to generally retracements on trends. Okay, so if you have a move up, it will retrace a certain amount. So one way of trading is to take your Fibonacci retracement tool, which you can find on TradingView, and draw it from the bottom of a move, right? From the bottom up to the top. So there's the bottom of this move to the top of this move. And then I'll drag it across so you can see it more clearly. And this, what's on the screen, these are the Fibonacci retracement levels. Why do they matter in trading? Just like anything, just like a trend line, just like a chart pattern, like anything you can imagine in technical analysis, they only matter because other traders believe they mean something. Yeah? So, some traders believe the prices in the market will follow a natural pattern, and that the Fibonacci ratio is one way of estimating this. That's all it is. So after a big uptrend, traders look at the subsequent pullback. So you know from the lessons on supply and demand that nothing can go up forever. Eventually it will reach a point where there is more supply than demand and it will pull back. What traders are doing by using the Fibonacci ratios are trying to just find and estimate high probability areas for where it will find support and continue into another leg of the trend. And so they draw these levels: 0.236, 0.382, 0.5, 0.618, 0.786, and they use those as the levels. Now, 0.5 is not a Fibonacci number. That is simply a 50% retracement. Yeah? You've got the low, you've got the high, and in between, you've got a 50%. So it's a 50% retracement. That is quite useful because it actually just represents common trading belief. Yeah? Prices, after going up, they often retrace at least 50%. I actually like the 50% level more than most of the Fib numbers. I don't particularly put any stock into the 236 or the 382. The 618, 0.618, yes, that can have some value, some interest, purely because a lot of traders will buy around that level. And if enough people believe that that level is going to hold, it's a self-fulfilling prophecy and the market will hold at that level. To be clear, the Fibonacci tool is a tool. It is not a predictor of the market. It will not make you rich. It will probably make you extremely poor if you try to just blindly use it. Make that extremely clear, right? And like every single form of analysis that exists on the planet, it is not always right. The markets are influenced by a wide range of factors, right? Fibonacci's are one of those factors. They are not a predictor of future price movement. So what you should think of the tool as being is a tool for understanding and possibly estimating an area where the market might react, not a guaranteed path to success. They're used because they seem to work. Yeah? They're used because other people seem to use them, and over time the market might react well at them. But as you can see in this example, if you're waiting for the 0.618, you never got it. Yeah? If you blindly were buying at the 0.382, you got wrecked. So as always, they should be used in combination with other factors. But this is just supposed to be a very simple overview of what it is. This is exactly what it is. It is not magic. That is how you use it. Now, to be a bit more in depth, in a trend, okay, very specifically in a trend, actually, this is a good example here on the screen. In a trending move where you have a low to a high, if the trend is going to continue like it did in this example, it should not pull back past the 0.618. Okay? The very simple reason for that is that if a market is actually bullish and is trending, or even if it's bearish in the other direction, it should not go so far back as to reach the 786 or even a 75, which you'll find out in another lesson. All right? So a simple rule of thumb is that the 0.618 is as far as a trend should pull back if it's going to remain a valid trend. Does that mean that it can't pull back lower and then go higher? Of course it can. The market can do anything. We're not trying to find certainties here. We're trying to find probabilities. And the probabilities are, if it goes further back than 0.618, it's probably not going to result in a trend. All right? It's going to result in a continuation of a range. That's the one main rule of thumb. All right? I do not recommend buying in a trend the 0.236 or the 0.382. If you find an example where price is in a trend and it seems to meet some of those criteria, so let's say each leg of your trend is discrete, all right? So I'm going to use the wicks on this, and I'll stop for a second and talk about wicks. Traders will say, do I draw my Fibonacci levels from the wicks to the wicks, from here to here, or do I draw them from the close to the close? Just like with any other type of analysis, it is completely subjective. Remember, these have no magical predictive power. They are simply a way of estimating. So the best way is to say, what will other traders be thinking? Generally, traders include the wicks in their analysis because that is valid price action. The price actually went there. And so for me, I would draw it from wick to wick. If you want to draw it from candle close to candle close, be my guest. It's not going to make a material difference because the Fibonacci tool is not a trading strategy. It is simply a tool that you use in combination with other factors. So in a trend, you have a low, and then you push all the way up to the first significant high, and then it has a pullback. All right. So we drag this across. You can see here that in this trend, it reached the high, and then it pulled back, not as far as the 0.382, and then it went higher. So what does that mean? Well, for one, your Fibonacci tool is not magic. Great. For two, it continues the trend. Why does the trend continue? Does the trend continue because it pulled back to either of those levels? No. The reason the trend continued is because there was strong buying, there was more demand than supply, right? And the buyers were able to push it up. It's just a coincidence, or it's just something that happens along the way, that it doesn't go to the 0.5, it doesn't go to 0.618, it doesn't go to the 786, purely because the market is in a strong uptrend, right? Then, if you want to trade each leg of a trend, and you say, the bottom of this leg was here, right? So after this leg, up to this top one, this is your next leg of the trend. You can have this one or the eventual wick up here, whatever you want. You'll see in this one, it does have a very shallow pullback to the 0.236. When that breaks out, if you have a breakout trading strategy, you could say there was a valid fib retracement. It went to the 0.236. It then broke out. And if I had a valid setup for my breakout trade, I could go long. Again, you don't go long because of the fib. You use the fib in combination with other factors to indicate and estimate a high probability trend. If this had have went down like this, if it had have not stopped at the 236 and had have went like that and then up, personally, I would be more hesitant on buying this breakout. Why? Because it had violated the trend principles, and it was more likely then to probably not do all of this nice big extension, but more likely to come up and then reverse. more likely to push a little bit above the high, but then fall back inside. That's because your fib lines, your fib levels, can give you a nice estimate of the strength of a trend. So the fib here, far from being magic, it just merely helped you to spot that the trend was strong. All right? That's what they should be used for, as a guide, as a visual aid. If you find that they help you to visually view these markets, view these moves, then great. Same thing again. We have this low all the way to our eventual high at the top. We drag that across. Now you can see here how the overextended final leg of the trend comes back down, stops at the 0.618, rallies up, but then breaks down. So, another good example of how coming back to a fib level does not indicate trend continuation. Anyone here who's watching this should know from the trend lessons that this was a extended trend and then an overextended trend. And if your only bullish reason to buy here was that it hit a 0.618, you're trading wrong. There were many signs, which you'll see them in either the trend following lessons or the mean reversion lessons or any of the lessons that talk about trend reversals. You'll see that there were many, many reasons to believe that this could be an end of a trend, not a continuation. So again, the fib by itself is not magic. You have other factors that are much, much more important in the market. There might be 5% of people, 10% of people who really put value in the fibs. That leaves a huge section of the market that do their buying and selling for other reasons. Okay? So that is the Fibonacci tool overview. That is how it is explained. It is the exact same for an uptrend as a downtrend. It is a visual aid, and that is all it is. You are looking at it much like a trend line. If you draw a trend line, it doesn't mean the trend line is magic. It means that if other people see that trend line and they take actions based upon that, the market might move in a certain direction. Probabilities, not certainties. If you remember that, you use your fibs in the right way, you'll do well. All right, I'll do some fib wizardry with the concept of ranges next and talk a little bit about that. Then I'll answer some questions. Find a nice area where we had a range. That's a pretty good range there. Came down, set a range high, range low, and then eventually broke down from it. Or should I find one that has, maybe I'll find one that has a nice example of the 20% rule. Here's one here that I remember from a while back. There we go. Okay. All right. This lesson is going to give a quick overview of using the Fibonacci retracement tool when trading inside of a range. So in the range trading lessons, I explain how to use a fib in a range. So this lesson is not about marking the range. It's not about how to identify the range. It's purely about how the tool is used. So if I draw it from the range low, which is just the lowest low we had, to the first bounce and then the high of that, right? That's one way of drawing a range. There are many ways of drawing ranges that are explained in the lesson. What I do then, previous lesson taught you about the standard Fibonacci retracement levels. This is not about that. This is about a range, and a range should be split into equal parts. So you put a 0, 0.25, 0.5, 0.75, and a 1 on your range. Actually, should be a better way to draw it is from top to bottom. So it looks like this. You have the 1 at the top, and you have the 0 at the bottom, yeah? Just makes it easier when you look at the range low and the range high. You've seen this from the lesson. So, why does this matter? When the market is not in a trend, you want to consider the range high to be expensive and the range low to be cheap. Because when it's in a range, you trade it in the range until the range breaks. There are two things to talk about, which are the standard levels, which have been covered in the range lesson, but I'll cover them again. From 0 to the quarter, so 0 to 0.25, that is your discount zone. You can mark that in green if you wish. That is generally an area that if it holds, you would like to buy. Then, if you did buy, where would you target? You would target the top end of the range, which is known as the premium zone. You can mark that in red. Very simply, that is how you trade a range. Okay? Now, the part I want to talk about here is the 20% rule. Because, of course, nothing is perfect in markets. And as you know from the liquidity lessons, the market moves to high probability areas of liquidity. That leads to it doing these sweeps, wicks above, wicks below, to grab the stop losses of traders, right? Either the stop losses of shorts or the buying liquidity of breakout traders, or the stop losses of longs, or the selling liquidity of breakout traders on the downside. The 20% rule is just a very simple mental model. You put a 1.2 and a minus 0.2 on your chart. That's all you need. And that gives you your areas of deviation where you can consider it to be a sweep, a false breakout, not a range break, and that the range remains valid. So if we look at this range, I'll break it down. The range low gets set whenever the bottom is in. We then bounce up to here and set the range high. Remember that as this is developing, you're not 100% sure that the range is set, but the range trading lesson shows you how to estimate that with a high probability. Then, when price comes up to here and it goes above the range high, what you want to know is this range still valid, or is it actually now broken and we go up? You simply do nothing. You wait. And as this closes, so this is a 1 hour chart, as this 1 hour candle closes, back inside the red zone with a wick above, and the wick doesn't deviate beyond the 1.2, you can say this is still a valid range. This range is holding, and I consider it to be a sweep, a false breakout, not an actual bullish move. It then moves to the other side of the range, deviates below the range low, same thing, comes back inside. Even comes down again, deviates again, but comes back inside. You can say in both those instances, it's supported and it stuck to the 0.2, the 20% rule. That is still a valid range. Okay? Why is that? Because it's either going to break and hold, or it's going to false break and reverse. One of those means the range is valid. One of those means we are probably moving into a trend. Yeah? Going below the range low or above the range high, but then reversing, is a key sign that the range is valid. That confirms your analysis. Yeah? Because it was clearly just a hunt of liquidity. Took liquidity, came back inside. Took it again, came back inside. That's just grabbing stop losses. Why would it grab stop losses and reverse? If it's grabbing stop losses and reversing, it's going to move, most likely, in the other direction. That means you can set up a range trade from one side of the range to the other. Now, in this one, if you zoom way in, you'll see that the wick just goes ever so slightly below the 0.2. Do not be autistic. All right? That is fine. That is valid. If the wick goes all the way down, let's say the wick went all the way to a hypothetical minus 0.4. The wick went all the way down there. You could say, okay, that's showing extreme weakness. Why? Because it's supposed to be just grabbing the liquidity. It's supposed to be stopping out traders. It's not supposed to have to go all the way down there. If it did that, even if it can back up on a wick, it's more likely that the resulting bounce would be weaker and that it would eventually go down and actually break the range. But it didn't. It supported it. It stuck to the rule. And therefore, you can look at longs in the green zone to the red zone. Now, how does this get violated? Well, luckily, we've got a perfect example here. As you see, price comes up this time, breaks up into the 0.2 or the 20% level, closes strongly inside it, and then breaks above it thereafter. As you can see, price never comes back. So you know, given that you've got your 20% rule, it had a sweep one time with a wick and it held. Went above, came back below, valid range. Comes up again, closes outside the red zone. So there's your first warning sign. Then, obviously, breaks out and holds. That is a valid range break. We now go into a trend and we trend up until such times as the trend ends. That is how your violation of your 20% rule is the best way to actually estimate that a trend is starting and a range has ended. If you strictly go without the 20% levels, if you just go from the 0 all the way to the 1, you're going to have to do a lot more guessing. If you add that little bit of leeway, 20% either side, That gives you strong confirmation when it does break, and it will break. Every range eventually breaks. That will give you the strongest confirmation that the range has in fact broken, it is valid, and we now are highly likely to be in an uptrend, or on the downside, into a downtrend. This is valid on all time frames, on all coins, on all charts. Every single chart that's ever existed can only move in a range or in a trend. This principle is simply designed to help you estimate trends and ranges, so it is valid everywhere. It does not work 100% of the time. I'll finish with this. Nothing in the market is certain. However, this can certainly make you a better trader, make you avoid bad trades, and hopefully take better high probability setups. So play around with it, use it, observe it, take notes. Don't ape your whole net worth in on the first trade of it. Test it, test it, test it, and you can do well. That's the lesson on using fibs in a range and the 20% rule.